Stocks are starting to feel the love again. It looks like those equity inflows are climbing. I'm here with Ben Willis from Albert Fried. So we were just talking about that one, it could be that it's just the beginning of the year, people are putting their money back to work, but we were also talking about bonds, and let's go into that a little bit deeper as to the reasons behind this push into equities.
I think that part of the inflow we saw was definitely the January effect, the new money coming in and being put for asset allocation. But I am hopeful that the way the tea leaves are lining up on this is an indication of money that realizes if you're looking to retire, it's not going to happen in a very quick period of time if you're in bond funds. And the math on, there's a good piece in the Journal today to explain the math on 50 basis points move in interest rates in the U.S. Treasury markets on the 10-year or 30-year bond has a dramatic impact to the pressure on your principal. In other words, what you lost last week in the 30-year Treasury, you lost in principal 3.5%. Your coupon that you're getting 3% on your 30-year was lost in last week's move alone. So that when people start to open up their bond statements and realize that the mattress of U.S. Treasuries is not quite as safe as they thought that it was, that doesn't mean they're not going to get paid that amount going out for 30 years. But the risk of holding that and the investment opportunities elsewhere, like equities, is going to be lost. So that's lost income if you look at it from a pure financial point of view.
We also know that from the Fed's minutes, there was a lot of talk about them perhaps starting to cut back on their bond buying, that this was going to affect things. And then we've got Mr. Bernanke speaking, so hopefully we're going to get a little bit more color on that.
Right, we had Mr. Evans talking about putting a little bit more timeline on it going out to 2015. The point I think people need to take away from it is if the two of the major legs in the bond market, the biggest gorilla is the United States of America. So if you take out, in some areas, 80% of the marketplace buying power, then you remove the retail sector that has been pumping money into that, who's left to buy them? On the greatest fool theory of investing in any security in the world, that's a little scary to who's left to buy them, and that only means interest rates go up on a natural progression as opposed to manipulated by the U.S. government. So you keep that in mind when you're looking to buy a bond and what your exposure is on the principal.
All right, well, there are a lot of stocks out there with some great dividends, so even though the taxation went up on the dividends, it's still probably going to be a better place to get that income. That's Ben Willis, and I'm Deborah Borchardt reporting for The Street.